We briefly touched on interest rates. I think it's an interesting question.
When the US raises interest rates, it competes against liquidity everywhere because the dollars that an investor lends to the Fed are the same dollars that it could potentially lend to a Bitcoiner, right? So you have to then match and surpass the Fed, right? So there's a risk premium over the Fed on everything, whether it's corporate bonds, Bitcoin lending, everything, right? So what I want to focus on is the delta between Fed funds rates and the effective loans rates. When these products came out back in 2018, lending was happening at 18%. At the zero interest rate environment, before everything blew up, companies were lending like sub 10%. We were lending at 8, 9%. So the trend is down. Now, when the Fed came back and raised rates from 0 to 5.25 again, obviously everything went up again. But the delta over the Fed funds rate is getting compressed and compressed and compressed and compressed. And it will continue to do so as operators continue to perform and show that Bitcoin, the loans are fully collateral, there's no loan losses, and you're getting a great yield out of it. So I see a world where lending against Bitcoin will be cheaper than lending against US real estate because it's a better collateral asset for the lender.